and welcome to the second homework set here. Again, this will coincide with the debits and credits material. As you can probably see plainly right there on the screen, that seems to be what's being emphasized here. So all this first portion of the homework is focusing on is just basic interpretation of your debits and credits rules. So again, just as a quick recap of the basics here. Again, the normal balance side is also the same as what? The side that you increase the balance of an account. So anywhere that in any of these where you see the word increase and whatever the account name is after that, that should also be equal to the normal balance side. Anywhere it says decrease, it would be the opposite of the normal balance side. So the way that you should proceed mentally through this exercise is first, obviously, you're referencing your normal balance rules, as you hopefully have already mastered them to some degree. Again, using the flashcards that I provided or some of your own design, doesn't matter what we're talking about here. The only thing that's important is that you master those normal balance rules. That is that's the bottom line. Because as I described in that video, this is the biggest stumbling block that you will encounter in accounting. That's just my experience has proved that out over the years. It always seems to be this is the place where people get hung up. So you have to try and master it as best as possible. So the purpose here, this sort of like what's the decision tree here? Let's just look at the first one. So for A, I said increase common stock. Okay, so the first thing you should think of is what's the normal balance of the common stock account, because it's going to be the same as increasing. Those are equal to each other. So normal balance, that's a credit. So that's why, of course, the answer is just credit. You're done. All right, now for B, decrease accounts payable. Okay, line got a little bit ahead of me there. So so the normal balance of the AP is a credit because it's a liability. So if we're decreasing it, that's why you'll see the opposite would be true. So that's why the answer is debit. So that's like your thinking here. Now some of them can get a little more complicated because they're dealing with maybe some new account names that maybe you're a little less familiar with. So we'll tackle those as we go through them. Now for C, decrease prepaid rent. So the first thing you have to ask yourself is, what is prepaid rent? Right? This is kind of a newer term. So remember, that was one of those classifications of current assets that was described. So it's a current asset. So what's the normal balance of an asset? That would be a debit. That's how we define them, and look up the balance or increase it. So decreasing it means we're reducing it, so it should be a credit in that case. Would be the proper application. Okay, increased dividends. So again, dividends, normal balance is the same as an expense account. Has the same impact. Remember, it's not the same though, but it will ultimately have the same impact on retained earnings as an expense. If we're increasing it, it has to be equal to its normal balance, so that's going to be a debit. Right now for E, we're going to decrease salary expense. So in this case, normal balance of your expenses, as I just said, was a debit balance. So if we're decreasing it, it should be the opposite, or crediting it. And just so you know, we would probably only normally do that, like see a decrease in an expense account, unless you made a mistake and you had to do some sort of a correcting entry. Only time you would normally see that would be when you're doing your closing entries, meaning you're actually transferring that balance of the expense account ultimately to retained earnings. Otherwise, you wouldn't normally see that during the period. Right. F is decreasing accounts receivable. So again, what's AR? AR is an example of an asset account. So normal balance is a debit. So if we're decreasing it, therefore we need to credit it in that instance. Increasing fees earned. Right, so what was fees earned? Fees earned is R, just to kind of keep up with I know I kind of skipped it up here, didn't I? I don't always follow all of my conventions in these videos. You probably have already noted. That's the way it goes. And it would be also true if I was doing this in a live lecture. I'm not always 100% consistent. Oh, well, that's just the way it goes. I'm trying to give you the live lecture experience is what I'm saying. All right, so fees earned is an example of a revenue. Normal balance of those is a credit. So if we're increasing it, should also be a credit. Right, decreasing unearned fees. Now this is a new one. This is a strange one here. So unearned fees, remember that was that example of a specialized current liability. Anytime that we take money in advance from a customer before we've actually done anything, which could, in this case, it means provide a service, or it could mean that we've actually shipped out the goods to the customer. If that's the instance, we have to put that in a liability account and label it unearned, meaning the expectation is we will eventually, fulfill what we've set out to fulfill the customer. We'll provide the service, we'll ship them the goods, whatever the case may be. But in the interim, gotta call it a liability, because what if we never, provide that service, as is true in this case? You got to stock it in the liability account. So that's going to be usually what? It's going to be a credit to that. So just to go over the whole entry there just for a second. So if you receive the cash in advance, you debit cash, credit earned fees, your liability account. In this case, it says we're decreasing it because what happened? Well, probably did what? Probably made good on our promise to our customer to provide a service. And now that we provided that service, we're going to debit that out of there because we no longer owe them that money. And of course, the other half of that entry here, just to give you the whole picture, would be what? Would be a credit to fees earned. That's what you would customarily see. We reclassify that now as revenue because we've earned it. A little more in depth than maybe you needed there, but it's just some of these, like that one, I like to go through the whole, idea because it's a little bit newer. Right? For I, we're decreasing equipment. So again, equipment is an example of a property, plant, and equipment, a fixed asset. So fixed assets normal balance is a debit. So for decreasing equipment, you'd be crediting it, and that would be an indicative of what? Like if you're selling it off. Increasing notes payable. So again, if you see the word payable, your brain should go, payable equals liability. Normal balance is a credit. So for increasing it, also would be the same treatment, credit. Lastly, prepaid insurance. I'll try to keep with my convention here. Some sort of a pointer, slash, line, smear, whatever the case may be. All right, so increase prepaid insurance. Again, that's another example of a current asset, a prepaid. It has it right there in the front there, like the prepaid rent. So if we're increasing it, that's its normal balance as a debit, so it should be the same, and it is. Again, so that's like the whole logic here. Obviously, over time, you simplify that to just, it's just sort of an instantaneous response. You don't really think about it in those slow motion terms, but this means just sort of just slowing down the logic of what you're doing there. All right, so that concludes part 1 here. I was going to go to part 2, but that ended up taking a lot more time. And again, I don't want to make these videos too long so that you can kind of parse it out and not have to worry about like where was I in video so-and-so. Some of them go on a little bit long, but the homework ones I'm trying to keep a little bit shorter. So look for part 2 in the next video. See you there.